Okay, so we'll just talk about some general motivational issues, okay? In case anybody else is feeling, so I would first say don't let your, one second, don't let your self-esteem or your view of yourself be defined by your grades, okay? Grades are very arbitrary. All kinds of imperfections exist in the grading process. You evaluate yourself based on how much work you put in, okay? So you have the poster child, the main few words for you to remember, essentially words like work ethic, okay? And work ethic is basically, it derives from discipline. Actually, work ethic you can have, and it's kind of difficult to distinguish between the two. Work ethic, you heard of Elon Musk? So Elon Musk is a multi-billionaire. He doesn't need to work at all, okay? But he's working like 18 hours a day or 16 hours a day or something. He actually has a pillow underneath his desk in the Tesla factory, okay? And that's where he's sleeping. So he doesn't need to work like that, okay? That's what so that's why I always say that Elon Musk is the poster child for work ethic. Okay, if you want to explain work ethic to somebody, that's what it means, okay? So the most important thing in the world is actually work ethic. All right, so so define yourself by what you have substantively gained in a particular day. What have I achieved today? What real gains? So grades and all these are all very superficial things, okay? Grades, exams, degrees and all that, nobody really cares. Once you go into the workplace, whether you got a C+ in IFM or whether somebody else got a A-, no one really gives a damn. Okay, what people care about is how clear your concepts are, how well informed you are, how confident you are, how how you're able to get things done to deliver results. Okay, whether you're a good salesman or you're a good trader or you produce great research, this is what people care about, and that has really no correlation to. I mean, the correlation is very weak. Is that clear? Okay, so yes, people don't seem to be very convinced about what I'm saying. In case you're getting, so I guess most of the people are not very disappointed with the grades. Okay, good. So that's fine. I just had a concern because some people were a little bit disappointed. So the other thing I would say about trading, okay, other thing I would say that in trading, this is very important to write down actually. In trading, because trading is a very peculiar kind of business, okay. So effort. So it's very important to understand also for you when I want to make a career choice, okay, as to whether you want to be a trader. That's this kind of thing is very important. It's a very unusual kind of business, okay. Effort not equal to is not equal to say let's say good results. I'm just going to use shorthand here. Good results. Here by not means not necessarily, okay. Doesn't mean that you'll always not get good results. Not necessarily equal to good results in, I'm not going to write in the short term, in short term. Short T means short term. Okay, I want to just cut down my time here, or even med term is medium term, okay. So trading is a very peculiar kind of business. It's distinguished from other businesses, like if you're an accountant or a lawyer, you're working for 15 hours as a lawyer, you bill your client for 15 hours, work is directly proportional to compensation. Is that clear? But in trading it's not like that, because markets are unpredictable. You don't know what's going to happen. You may work extremely hard, and somebody who doesn't work very hard and just through luck in the short term, and even probably in the medium term, okay, 2-3 years, maybe you can have a run of luck. Good luck, basically I define good luck as when you're doing stupid things and you're not paying the price. It's a useful way to think about good luck and bad luck. And bad luck is when you're working extremely hard and still not getting the results. Okay, so yesterday I gave the example of Andy Murray. Everybody knows who Andy Murray is. So there was, at least I remember, 3 to 4 years on the circuit where Andy Murray was one of the top 3 or 4 players on the world, and he was getting to quarterfinals, semifinals, and he was not making it. Okay, it was heartbreaking. And you remember, if you see in that Wimbledon final where he got beaten by Federer, he actually started crying. On center court, he was crying. That shows you the hunger to win. And what did Andy Murray, what was his work ethic? He's known as he has the most brutal training regimen on the circuit. And his reaction was, every time he lost a tournament, he would go and step up the training regimen even more. Okay, so that's what so it can happen to people like, and it happened to Federer also. For about 3 or 4 years, Federer, who's clearly the greatest player in history, was getting to semi-finals, finals, and not winning the Grand Slams, right? So imagine how it must have been for him, for a player like that. And he kept on playing. So that shows you what can happen in life, where you can have a stacking of bad luck, okay? Bad luck is when you're working extremely hard and you're still not getting results. And good luck is when you're doing stupid things and nothing happens to you. You don't pay the price, right? So you get both. and they usually come like there's a run. Okay, you understand what run is? Theory of runs. We did that, run of losses, when we were planning our risk.
Yes, sir.
A run. So you should be, as an MBA student, you should be familiar with this concept of run. That you can have a run of heads, even in an unbiased coin. You can have a run of 6 or 7 heads in a row. No big deal. It doesn't mean that the coin is biased. Okay, because that 50% is only for very large number of trials. Okay, so the point is that. So what was I saying? How did I get into this bad luck, good luck? Before that I was saying work ethic. Okay, so I was explaining that this work ethic concept also connected to this. So the point I was trying to mention is that so in a way trading is also like that. It's not like lawyering or being an accountant. Accountant bills the client for 20 hours, he does 20 hours of work, bills for 20 hours, gets paid for 20 hours. So in certain areas like sports and trading, okay, where the rewards are also very high, but you can go through lots of periods where you don't get results. So some people like Survi, you're feeling demotivated that you did a lot of work and you're not getting a good result, but that can easily happen in trading. Okay, you see lots of great traders who have now got into troubles. They have returned all outside money, they're just managing their own money. It's happened to many great, there are very few traders who are continuing with I think Steve Cohen is the only great trader who's not really had a bad year. Okay, everybody else, pretty much everybody else has gone into decline. James Simons of Renaissance Capital, that I told you about, Renaissance Technologies. Okay, so these are the only 2 people who I know that who have maintained consistently good records, trading records. So it's very difficult. So this is something you have to deal with. But in the long run, if we go back to this, in the long run, okay, I'm not writing the long run. In long run, okay, in the long run, you are, if you are also working smart, that is also working smart means working hard and working smart. You know what working smart is, right? Okay, so working hard, you may be working very hard, but you might be kind of stupid, like you're trying something and it's not working and you keep on trying that same thing. Obviously you're working hard, but you're not working very smart. Okay, so you have to have some kind of smart, you have to have some instinct for the market, some sense of good risk management principles, etc. Okay, so this will give you a sense of what is involved in trading. It's an unusual kind of activity. Okay, so this is what I wanted to mention. And then once again I wanted to, so because of this kind of situation, that's why I said, if I go back to the advice that I was giving you the other day, that you need to have something beyond where I took off on Rajan saying that, you know, I don't want to come to college on a Wednesday. So if you want to deal with life, because this is what happens in life. You see, I gave you the stories of Andy Murray, Federer and all these people, right? So it can easily happen to you that you're going into a period of bad luck and you're not getting any results. Okay, you're working very hard and not getting any results. At that time, if all you have within you is basically what I like and what I don't like, you know, it can crush your spirit. You need to have something beyond. You need to have a sense of a higher calling, a sense of duty, okay, a duty to your own talent, okay. These kinds of things you need to develop, okay, because normally when we were at your age, nobody told us all this stuff. We had to figure it out along the way. All right, so that's why you understand why the Gita says this, that don't do your duty and don't worry about the consequences. Because if you worry about the consequences, things can get so bad for so long that you would not be able to function. That's why this message is there, that you have to focus on doing your duty. So this you will understand, hopefully you understand it directly right now. Maybe sometime later you will understand what it really means, but at least remember this, okay? All right, so yeah, so enough with the lectures. Any questions? Go back to your lab notes. I've also given you a link to the Enchiridion, the book by Epictetus. What Epictetus is saying is not very different from Epictetus, a famous Greek philosopher, who was the guide, who was basically the mentor to Marcus Aurelius. You know who Marcus Aurelius is? The great Roman emperor, a great conqueror, okay, but he was also a philosopher. So Marcus Aurelius, if you guys have seen this movie called The Gladiator,
yes, sir.
Russell Crowe.
Yes, sir.
So in the early part of The Gladiator, there's an old man. Joaquin Phoenix murders an old man.
Yes, sir.
In the early part of the movie, he murders his father actually. So that is the figure of Marcus Aurelius, the old man played by Richard Harris, who gets murdered. That's actually the character of Marcus Aurelius. He was a great Roman emperor, but he was coached by Epictetus. Okay, so remember all that. Go back to your lab notes on personal effectiveness. The first lecture in lab is personal effectiveness. Go back to that and you have a lot of these links there. Okay, you have to develop a way of thinking about life in these terms as well, so that you are resolute and, you know, strong in times of adversity. Okay, let's go back now to our case. We were at this point, so we have had a 10-minute philosophy lesson. I hope you didn't find it boring. Okay, good. Now, where were we yesterday in the last class, where Verma had identified the question? We were basically going through these questions in the case. All right, the question in the case, the second question is what we were attempting. Okay, what are the underlying positions? Now we are going through this. I hope everybody has read the case and you've understood now the structure of the balance sheet. Okay, we're going to use this to try and understand all the core concepts in corporate treasury risk management, which is basically the management of a, now we are learning how to manage, what are the key concepts for managing a passive risk book. A passive risk book is what exists on a hedger's balance sheet. Okay, not a speculator's balance sheet. All right, so underlying positions. Okay, we are trying to understand that. And where do we have, what do we have here? The last point we reached was, we already figured this out, and we came here and Burma told us that the underlying position. So as I said here, we are going to do this by looking at dollar yen, the spot dollar yen, okay, where the dollar is the base currency. We are not going to look at, we are not going to form our views based on yen futures, okay, because nobody really does that in the market. Yes?
Can you please explain passive risk again?
Okay, passive risk book is, the reason we say passive, you remember the distinction between speculators and hedgers?
Yes.
So speculator starts with no risk. Okay, quiet here guys. Why are we having all these murmuring? There should be no murmuring. Any questions you ask me. Speculators and hedgers, you understand the difference? Okay, so the speculator already starts, the speculator's first transaction has to increase the total risk. So he starts with zero risk and the first transaction will increase the risk. And the hedger we've defined as first transaction reducing the total risk, which obviously implies that there is already some risk. If there is already not some positive risk, how will you reduce it? Yes, because we in deciding risk, we don't go into negative territory. We stop at zero. So it's zero and on the positive side. Okay. So is this clear from the definition itself? That if we are saying that the hedger has to first reduce, the first transaction must reduce the total risk. That means it's obvious that there has to be some positive risk on the books. That's what is going to be. If it's not there, if there isn't any positive risk, if somebody's getting a zero salary, then what? How do I reduce his salary? I can't reduce a salary of zero, right? Are you following? That in the definition itself, there is the idea that there is some pre-existing risk on the hedger's risk book, on the hedger's balance sheet. Is this idea clear first? Right? Okay. So this, if you want to go back to US constitutional law, where they talk about the right to bear arms, okay, the right of the citizenry to bear arms shall not be infringed. So they say that it's a pre-existing right. They're talking about a pre-existing right which shall not be infringed. So similarly here, if you're saying that the risk has to be reduced, okay, then there has to be already some risk. Otherwise, what will you reduce? All right. So what is that pre-existing risk on the hedger's balance sheet? Why do we call it a passive risk book? Because we went through that already. You look at this balance sheet when we already went through the asset side. Okay. So as SG1 and some other people told us that the positions here are long. The underlying positions here are long. So this company has no, and we went through this discussion that this company has no desire to be a speculator. They are not trying to speculate on copper prices or oil prices or gold prices, because if you wanted to do that, it would be much more efficient to do it through futures contracts, right? You don't have to deal with unions, you don't have to buy mining equipment. Okay, you don't have to buy drilling equipment and all that. It's much cleaner. You just get in and out of positions in one click. Okay, so in that way, this is a very clean kind of business, because you can imagine you can get rid of your inventory in a few clicks. If you're running a speculator's book, okay, if you're running an active risk book, if you think of it as a kind of business, like if you're running a computer hardware store, you buy a whole bunch of inventory and then that technology gets outdated for some reason, and then you're stuck with this inventory. You have to sell it. Imagine the headache. Whereas here, trading is a kind of business, we can think of it this way if you want to think of it in inventory terms. This is a business where you can get rid of your inventory in a few clicks, right? So if I'm holding, say, 500 oil contracts, okay, all I have to do is click put in some numbers, and bang, out. My inventory is gone in 2 seconds. Yes, so this is one way of thinking about the trading business. Certain attractive features of the trading business, the speculative trading business, is that you can get rid of, one way of looking at it, you can get rid of your inventory in a few clicks. Okay, so that reduces the risk profile of the business quite significantly, because one of the problems that happens to all these brick and mortar businesses is you get stuck with inventory, then you need to have a clearance sale. Why do these people do these clearance sales? You know, huge discount, 50%, everything must go, right? Clearance sale. Why? Because they're stuck with inventory that is not moving, the product is not moving, they need to do these clearance sales to get this out. So the advantage here is that you can get it out very, very quickly, this kind of business. So if they wanted to speculate, as all they wanted to do was speculate on oil prices and crude copper prices and all that, they should have done it through futures contracts. It's much more efficient. Okay, but that's not what they want to do. They feel that they have some peculiar advantages. Okay, like there are some mergers going on now in the gold space with Barrick Gold, Newman Mining. These are very big gold companies, and Barrick has already eaten up one of the, I think, the Standard Rand Gold, a South African mining company. So so there's a lot of activity happening on the gold company merger side. Okay, so the point is, these people are in the business of, they feel that remember we talked about the value chain, right? So these people they feel that they have some special expertise in extracting the efficiencies from the value chain, and then they obviously capture the extra value. Like I told you that Saudi Arabia's production cost for oil is basically around $18-20. Okay, so anything above that, they have one of the lowest cost of production for oil, crude oil, getting it to the refinery stage. So if anything above that price, they're making money. Okay, so that's the point, is that they are very efficient in extracting those efficiencies from the value chain. They're very good at it. So that's why people go into these kind of businesses. They don't go into these businesses to speculate on oil prices or gold prices or copper prices. They're going in there because they feel that they're very good at because somebody has to mine the copper's that needed, somebody has to mine the gold. Okay, so somebody has to get the oil out of the ground. So who's going to do it? And they feel that we are good at doing this stuff, and that's why they go into the business. Are you following? So that's not their primary goal, is not to speculate on these prices. Okay, but because they're in this kind of business, you can't help but carry some inventory. You can't instantly sell everything that comes out of the ground. So it's not realistic to expect that. Every kind of business like this, every such business is going to carry some inventory, maybe less or more, whatever. Okay, so that's why now, because this inventory is basically items that are priced in very actively traded markets, like here. What is your inventory? Crude oil. All right. What is your other inventory? Gold. Then you have copper. All right. These are commodities. Your inventory is basically commodities that are very actively traded. So your inventory is being continuously repriced. I mean, conceptually you can think of it that way. The market is continuously changing the value of your inventory for better or worse, right? Yes, are you following? So you are not doing anything. You're just sitting there passively. You just mine some gold out of the ground. Now it's going to take you some time to sell it. It's lying on your books as finished goods inventory. All right. And now what's happening? The price of gold is moving around, and your inventories, value of your inventories, if you do your balance sheet conceptually every moment, the value of your inventory is fluctuating constantly, right? So this is a source of risk because it can go against you. Right, we showed you that we did this exercise the other day, and we showed you that if the value of oil drops from 57, 58 to 35, the value of your oil inventory is going to drop, and your accountant is, next time your balance sheet has to be drawn up, your accountant is going to force you to revalue the inventory down, and that will lead to a loss. That will lead to a reduction of your net worth. Remember, we saw that. We can see that one more time. We can reduce the price of oil. Notice what happens to this. Notice here that in this case what will happen, because on the asset side, notice another dynamic. On the asset side there is no residual factor. So when you have changes to the asset side, okay, in this kind of balance sheet, okay, in this kind of balance sheet on the asset side, anyway, even on a normal balance sheet you don't have a residual factor on the asset side. So when the asset side changes, the balance sheet size itself will go up and down. The size of the balance sheet. What is the size of the balance sheet? This This is the size of the, when we talk about the size of the balance sheet, we are talking about total assets or total liabilities. Okay, the size of the balance sheet. Okay. Now, if you change the values on the asset side, the size of the balance sheet will change. So notice that. Notice that this, why is the size changing? Because one component of the assets is changing in value. The market value of your quantity is not changing. The price is changing, so the market value of one component is changing, which is going to lead to a change in the size of the balance sheet. We refer to this as the size of the balance sheet. Is this clear? This is the size of the balance sheet. Now, so, and then of course what will happen when the size of the balance sheet reduces? Then obviously this will also reduce. Liabilities has to reduce total liabilities. And what are the two major components of total liabilities? Yeah. So Mehak has given the correct answer. It's the correct high-level classification is net worth and outside liabilities. Okay, that is the right way to think about it. And then you can further decompose outside liabilities into all kinds of debt. Senior debt, whatever. Okay, senior debt, subordinated debt, and all that. Now, can you change the value of the outside liabilities? If we do this as a ceteris paribus exercise, the value of outside liabilities does not change, right? The total is changing, and total liabilities TL is equal to OL plus NW, net worth. OL plus net worth. So if TL is changing and OL cannot change, then net worth has to adjust. So this is the residual part on this. So you see that the net worth will also go down. Okay. So now we are going to take this down from 57.93 to 35. See what happens. Okay. Can you see that?
Yes, sir.
Oil, market value of oil component, one type of finished goods inventory is going down. Value of total assets, the size of the balance sheet is shrinking, and total net worth is going down. This is clear. You should see it conceptually clearly in this way. So what is this? This is, they didn't do anything. They just took some oil out of the ground and they haven't sold it to anyone yet. Okay, because you can't run a business like that with zero inventory. Very, very difficult. Okay. So now what's happening here? So this, they did not want to speculate on oil prices. That's so, but they are still being hit with oil price risk. This is why I say it's passive risk. It's a passive risk book. Passive in the sense that I didn't do anything. If somebody goes out onto the road and gets drunk and starts walking in the middle of the road and he gets hit by a car, okay, then you can say that this guy was asking for it. Okay, but but if somebody is just standing on the sidewalk and a motorcycle comes and hits him, he's kind of passive, but he's also getting affected. He's also getting the same kind of result, right? He's also facing the same kind of consequence. Now you understand what is meant by passive risk book. That just by the nature of the business that you're in, you are getting hit with market risks. You are getting saddled with market risks, which you really did not. That was not your goal to be basically taking on those market risks. This is the kind of secondary consequence of the kind of business that you're in, of being in that kind of business. Is this clear? Yes, everybody's clear? Okay. So this is what we said. Let's rewind this exercise so we go back to our original values. Alright, so everyone is clear now? Okay, so we go back to the question that we were asking the other day. We will recap that question. That we are now in the phase of, so remember where we are. We are going through the questions in the case. We are trying to identify all the underlying positions, and in that sequence we are coming to the yen loan. Okay, this is the amount, the yen amount of the loan, and this is the dollar yen exchange rate, and the dollar value of the loan. And we said that even though you will be executing your hedge transactions in the yen with respect to the management of the risk on account of the yen loan, you'll be executing your hedge transactions in using yen futures. Okay, where in yen futures, what is the distinction? The distinctive feature of the yen futures contract is that the yen is the base currency. In the yen futures contract, the yen is the base currency. That's why you see these funny prices, right? But in this case, when you do your analytical work, that is coming out with a decision of what you're going to do, that I would suggest you do it on the dollar yen chart, because nobody really looks at dollar yen charts with yen as the base currency. It's very unusual, because the spot market for dollar yen is actually the spot market for currencies. When you look at currencies, the most liquid segment of the market is the spot market. Okay, different markets have different situations, okay, in terms of liquidity, but in this currency markets, the spot market is the most liquid. So we would look at the dollar yen, all right, to come out with our views, our decisions on what we want to do. All right. So what is happening? Everybody's falling asleep. Backbenchers are all falling asleep. Okay, good. So all right. So now the question is on the question of underlying positions. We in sequence we come to this question. Okay, then what is we see this yen loan over here, and we have already decided that we are going to see this as the risk factor that we talk about here is the dollar yen, okay, exchange rate. Okay, we say that the risk factor. So the underlying position is related to the KRF. Okay, the KRF here is the dollar yen exchange rate. You can represent the KRF as yen dollar also, but when we do the analytical work and take a view on the market, on the KRF market, we will do it through the dollar yen exchange rate with the dollar as the base currency. So the question will arise. The first question is to identify, with respect to this KRF, you've already identified that this yen dollar yen exchange rate is a KRF, because as it moves around, it creates movement on the values. I mean, it changes the balance sheet values, and therefore it's a source of risk. The key word to remember is the source of risk. A key risk factor. Why are we calling it a KRF? Because it's a source of risk. So now when we take our views on this, so we will use the dollar yen exchange rate. So the question arises now, with respect to the dollar yen exchange rate, what is Magma's underlying position? So what was the answer that Verma gave in the previous class? Long position. Okay, is everyone clear about that? Yes. Who should we ask? Shivam? Who is not? Parul has a disagreement.
No, I don't know the reason.
Okay. So let's do that. That's where we ended the class. So everyone should be clear about this. Okay. So let's look at this. So he said that the long position he said that the underlying position is long. Now let's go back to your notes. This is where the theory comes in. Where are your notes? Yeah, so you have, let's go back to the top here, underlying positions. This is right. So you understand the concept of the underlying position, that it is some position, and we have decided this. Now this is the rule that you have to follow. Okay, this is basically what you need to understand. Okay, you can say you want to memorize it or whatever, but at least you should understand. Really, it's better to understand it. There's no need to memorize every comma and full stop, but you should get the idea. The idea is quite simple. Okay, how do you figure out? You need some contextual. We went through these exercises. You need some contextual knowledge. You need to know that Norway is a net exporter, or you need to know that Japan is a net importer of crude oil. So if we ask you questions like, what is Japan's position with respect to crude oil? What is Japan's underlying position? Okay, you have to have some knowledge that, well, whether Japan is as to whether Japan is a net importer or a net exporter of crude oil. Okay, you need to have that contextual knowledge. Now you see this. Just read this. This is basically the logic that you should follow for any. So you don't need to memorize anything else actually. You just need to get the idea here. You need to have the contextual knowledge, and then you would ask yourself these questions in order to figure out whether this. We already went through this exercise in the previous class, so I'll go through it a little bit quickly, but make sure that you understand the logic. It's already in your notes, so you don't need to write anything, but you just need to understand. Basic concept we already discussed, that first you ask yourself, what happens? So if Japan is a net importer of crude oil, if crude oil prices go up, does Japan make money or lose money? They lose money. Then if crude oil prices fall, then does Japan make money or lose money? They make money. Okay, now you ask yourself, there are only two types of positions, long and short. Now out of these two, which position behaves in this manner? That when the market goes up, you lose money, and when the market goes down, you make money. It's a short position. So very simple. You already learned everything. Now you should never forget this logic. Obviously, if I ask you what is Chile's Chile's underlying position with respect to copper? Chile is what we normally call Chile here, but Chile is the name of the country. Okay, so does anyone know this contextual knowledge? How much of markets TV are you watching? What is Chile's underlying position with respect to copper? No one knows? Okay, so Chile is home to the world's biggest copper mining company called Codelco. So the biggest copper mining company in the world is Codelco. It's a Chilean company. So Chile's underlying position with respect to copper is what? Long. Because if copper prices go up, they make money. If it goes down, they lose money. Okay, this is part of your contextual knowledge. This is also important as part of your training. That's why I've told you to continuously watch business TV all the time. Right? When you're having dinner, when you're having whatever you're doing, right? So you constantly watch business television, you get all this information comes into your head. This is also important for your understanding of the world, along with what we call conceptual clarity. This kind of framework is part of your conceptual clarity, understanding how you would figure out whether any entity that is given to you, how would you figure out whether that entity's position with respect to a KRF market is long or short, underlying position. This is how you figure it out. Is everyone clear? Are you clear now? Okay. Okay, so this is basically it. So you can read this on your own later, but you already understood the logic. Okay, it's all explained here in great detail. So now you can test it here as well. We go back to our spreadsheet. So if the assessment is correct now, because what happens? Let's say we are looking at answering this question with respect to the dollar yen market. Okay, not the yen dollar market. So we're talking about the dollar yen market. So in this case, what will happen? What you have to think about is you look at the chart and you think about what happens if the dollar yen drops. Okay, suppose it goes to 106. Okay. If it goes to 106, does this company lose money or make money? How would you figure? Go stepwise. Go stepwise. Every question is very easy if you go stepwise. 1 minute. You know what this company's profile is? They have a yen loan. Okay. Now we are asking this question of what is the underlying position in the dollar yen KRF. If dollar yen is the rate is one of the KRFs, and so in this KRF market, what is the underlying position for Magma? That's what we're asking. Now, so for that you have your framework. You figure out if the market goes down. This is the market we are talking about. If the market goes down, do they make money? And if it goes up, do they make or lose money? That question you ask, and then you figure it out. Okay. Now, based on what you learned in your base asset, in your very first in your IPM, the initial units. Okay. The market is an exchange of assets. A market is a venue for exchanging assets. You have a base asset and a terms asset. And when we study charts, so when the chart goes up, here what is happening?
Go down.
Here what is the base asset? USD. When the chart is going up, what is happening? The dollar is appreciating or depreciating? Appreciating. It's getting stronger. Okay, because each dollar used to buy around 104 yen. Now it's buying 108 yen. So that's how, with the normal scale, you figure out that when the chart goes up, and most charts have normal scaling. Okay, that's why. So even to understand charts, okay, you should understand your logic very clearly. Is everyone following?
Yes.
Okay, the logic should be very clear, the stepwise logic, and then you do it so many times that then instantly, as soon as you look at a chart, you can figure out that this is the base asset going up. All right, or the base asset going. What is happening in terms of each of the assets. So if the dollar yen drops from 108.60 to whatever the price is here, the price is 108.54, kind of same. Okay, if we drop this to 106, is the dollar getting stronger or weaker? Some people said stronger. Dollar's getting weaker. Now each dollar is buying only 106 yen instead of 108.6. So if the dollar is getting weaker, then the yen is getting stronger. Okay, so each yen is buying more dollars. So if you have a liability here, now we can work this exercise, but I'm giving you a slightly conceptual way of, slightly abstract way of thinking about it. This also we have discussed in the past, that your assets are your revenues, although revenues are a flow concept and assets are a stock concept. But if you consider everything as being made, all sales are cash sales, and you recompute the balance sheet instantaneously all the time, right? That means all your cash sales are showing up as cash on the balance sheet. All your sales are showing up as cash on the balance sheet. Yes, if you assume that all your expenses are on credit and all your revenue sales are on cash, so your cash balance is building up. Yes, so therefore you can see a connection between revenues and assets. So we say that the revenues are like assets. So when you have liabilities and your asset liability mismatch, so if your liability is getting stronger and your asset is getting weaker, that's good or bad? That's bad. You're losing money, right? That's another way of thinking about it. So when we think about asset liability mismatches, another way you think about it is you look at what is happening to the value of the liability in terms of the asset. Here the asset is US dollars and the liability is in yen. So if the yen is getting stronger and the US dollar is getting weaker, then your asset, each unit of asset is buying only less and less liabilities. So you need to retire these liabilities. Are you following the logic? So you can just directly compare. That's another way of looking at it. Okay, we will do a mechanical yes.
Sir, this means the company is long.
Yeah, your answer is correct, but I'm taking you stepwise. You're moving a little ahead, like in the other class, Pulkit and Tanya were moving ahead already to the hedge position. So we are not going to go so quickly. We are going to go step by step. We want to first make sure that everybody understands the underlying position concept for all the KRFs. All right. So now Garvit is going to go back to sleep. Now that he has cracked it, he is going back to sleep. Okay.
Japanese to dollar to Japanese or Japanese?
No, that's what we have to be clear about. That's why I've done it. This is anyway how you would do it in the real world when you're managing risk like this. You would always look at the dollar yen exchange rate. Okay, that's where the most active market is, not the yen dollar. But in any way, that will make it more complicated for you, and you'll learn more, because when you actually go to hedge, you'll have to hedge using the yen futures, where the yen is the base currency. But let's first get the underlying position clear. Now let's do the test. Okay, so the answer that we already got from Verma the other day and also from Garvit today is the underlying position is long, because when the dollar yen drops, the dollar is getting weaker. Okay, and so therefore they are actually losing money because the assets are getting weaker. The asset currency is getting weaker and the liability currency is getting stronger. That's another way to think about it. Okay, because assets are what you own, liabilities are what you have to pay. So if your liability currency is getting stronger and your asset currency is getting weaker, then you have a problem. You're losing money. And now we can finally test it. Okay, so when the dollar yen goes down, you lose money. When the dollar yen goes up, you make money. Let's see that first hand on the balance sheet. We're going to change this. Now you notice what will happen is the balance sheet size will not change. Why is that? Because on the liability side, you have a residual concept. You have a residual and quantity, which is the net worth. So the net worth is able to absorb the changes in the other component, which is the outside liabilities. So the behavior on the liability side is different from the behavior on the asset side, because here the asset, you'll notice the total balance sheet value will not change. We will make the dollar yen drop in value, but the total liabilities, the balance sheet size will not change. What will change is that the outside liabilities component will go up. Okay, in particular here, one of the subcomponents of that, which is the value, the dollar value of the yen loan. So the market value of this will go up. We make the dollar yen drop in value. This will go up. This will remain unchanged, and this will drop. Okay, so it's one is getting bigger because the total can't change. One component is getting bigger, the other component has to get smaller to adjust. Okay, is this clear? So let's do that. We've probably did it once before. So let's make this even worse. Let's make it 105. So we're dropping it from 108.50 to 105. Can you see that? Yes. Market value of the liabilities went up. No change. Did the total balance sheet side change? Did the balance sheet side change? No. It didn't change, because increase in outside liabilities is compensated by decrease in net worth. Net worth, that's why you see net worth is also, that's why you see it's a residual concept, because now what is happening is total assets remains unchanged. Remember the equation? We should maybe write it once here also in your, I don't know if it's in your main notes. So this is a very important thing to understand, that net worth equals total assets minus Is this clear? So total assets remains unchanged. This one goes up. Yes. So this one also, if this one remains unchanged and this one goes up, then the net, this one, the LHS will go down. Like imagine this is 100 and this used to be say 60. Now this remains 100 but this becomes say 70. So earlier what was 40 net worth now will become 30 net worth. Yes, is clear? These concepts should all be 100% clear to everyone. Okay? Yeah.
The currency part is not clear.
Which currency part?
So can we discuss that it will go up and down from 108 to 106?
Okay. Okay, so let's do this one more time. So what is not clear?
Similar to a loan position.
Okay, what is happening? What did we do on the balance sheet just now? We dropped it. Let's reverse it now first. Then we go back to the original. Okay, we dropped it from 108.54 to 105. Okay, so we dropped it from 108 roughly here to 105. Okay, we dropped it here. So when you see a chart, when the dollar yen drop, when the chart drops, that means the base asset is getting weaker. Because the logic is this: the base asset is getting weaker because at 108, at a higher point on the chart, each base asset was buying more units of the terms asset. Each base asset was buying 108.50 of the terms asset. Now we dropped it to 105. So each base asset is now buying only 105 of the terms asset as opposed to 108.50.
It is getting stronger.
Yeah, don't jump ahead, go step by step. So the base asset is getting weaker. It's like gold. If the gold price drops from $1,400 to $600, okay, earlier it would cost you $1,400 to buy, or each unit of gold was able to buy $1,400. Now each unit of gold is able to buy only $600. So the value of gold has dropped. So we say gold is weaker in terms of dollars. Yes, same thing here. So the base asset is weaker in terms of the terms asset. Yes. So if you drop it, because if you, of course, you invert the scale, then obviously things will change. This is the normal scale where the lower parts have lower values, and at the higher level, at the top of the chart, you have a higher value. So if you invert the scale, then it will change. But obviously most charts have normal scales. So that's why we say that when we look at a chart and the chart drops, the chart drops means the base asset is getting weaker and the terms asset is getting stronger. And the chart goes up, that means the base asset is getting stronger, terms asset is getting weaker. This is clear? Okay. And then separately you can also see it with you can confirm that suspicion by changing the 108.54 to 105, and you see that this component goes up and this component goes down. That is because of what we showed you, that net worth equals total assets minus outside liabilities. Okay, so what used to be 100 minus 60 now becomes like 100 minus 70. So this goes from 40 to 30. It goes down. Yes, everyone is clear? All these concepts should be 100% clear. I don't think we were 100% clear coming into this course, were we? Not really. But are you gaining something?
Yes.
You're gaining a better understanding. Make sure these understandings stay with you. It's not like after you graduate and I meet you and then I ask you this question and then you can't, at your farewell party you can't answer this. Okay? So, all right. So please make sure that everything you learn is completely embedded in your brain forever. Okay? All right, so next question. So is this satisfactorily answered now? Why is the underlying position for Magma with respect to the dollar yen KRF market? Why is it that the underlying position is long? Is everyone clear about that? Vinotra, you're following? Okay. Okay. So next question. Now we move on with the same question to the next KRF, the Aussie loan. All right. Let's drop an Aussie chart here. Aussie chart. Okay. Yes. Aussie. Now, what is the loan currency? The loan currency is Australian dollars. All right. So your liability currency is Aussie. Your asset currency is USD. So now we are trying to answer this question of with respect to the Aussie-US exchange rate, where the Aussie is the base asset. In this KRF market, which is shown in this chart, is our underlying position long or short? So who's going to answer this? Surbi?
Yes.
What is it? The question is clear? Now because you're looking at your WhatsApp. Okay. In this KRF market, in this KRF market, the Aussie loan, right? You have the Aussie loan. So we are saying that the KRF market for this is the Aussie US exchange rate. We are taking the spot. In this case, you notice there's no difference between the two ways, the two quotations. Very little difference because the spot FX markets, the Aussie is the base asset, and in the currency futures markets also the Aussie is the base asset. So the consistency is there in the currency futures markets, where in the US currency futures markets on the CME, which you are going to be trading, the consistent rule is that the USD must always be the terms asset. That is the rule that they have applied. But in the spot currency markets, which are much older, they have different conventions for different currencies. Like in the case of the euro, in the case of the cable, in the case of Aussie, in the case of Kiwi, in all these cases the US dollar is the terms asset, but for dollar Swiss, dollar yen, okay, dollar Sing, dollar rupee, all these cases the dollar is the base asset. So they are not consistent in the spot FX markets. But the spot FX market is the more dominant market, the one which basically trades almost 5.1 trillion. The total FX market activity is around 5 trillion in the spot and forward is 5.1 trillion per day according to the last survey, which was around about 3 years ago. The new one coming up soon. All right, so that you can imagine that's the biggest market in the world by far. So what you notice here, another thing that you see here, because of the way that the Aussie is quoted in the spot market, there is no difference in the so this should be less confusing for you when you actually manage the hedge book, okay, because in both cases Aussie is the base asset. Yes? Okay, so the question, coming back to Survi, is that, who is already smiling before answering the question, but that is, now what is in this KRF market, what is your underlying position? Is it long or short? Short. Okay, which means you're saying that if the Aussie goes up and rises in value, you'll lose money, and if the Aussie goes down and drops in value, you will make money. Okay, so is her answer correct?
Yes, sir.
Okay, our answer is correct. You can apply certain rules to check, because what she's saying is, what is the liability currency? The liability currency is Australian dollars. So if the liability currency rises in value relative to the asset currency, she's saying that you'll lose money, and which seems to make sense, right? And then she's saying that if the liability currency drops in value relative to the asset currency, then you will make money, and which is correct. Okay, so therefore she's correct. You can test it also on the numbers. All right, and we can make this, let's say we want to make it this time let's make money. We've been losing money for a long time, so let's make this like 0.6. So 1.6. So from points, whatever it was, 6, 7, 8, 9 or something, we are making this 0.6. So what should happen? No change. Will the total assets balance sheet side change? No change in balance sheet size. This component of outside liabilities will decrease in value, so net worth will increase. Okay, so let's see that. 1.6, 1.7, 2.1. You can see that no change in balance sheet size, because there's a residual. So that the phenomena on the asset side and liability side are different, because on the liability side you have a residual factor, which is like a shock absorber kind of thing, right? And shock absorber also takes positive shocks as well. It absorbs both positive and negative shocks, right? This time it's a positive shock, so it goes up in value. Yes, Mehak, have you followed this? Clear? Gil, are you following? Yes. Okay. So this is your so we have determined now. Everyone is clear about this?
Yes.
Aussie underlying position is long with respect, underlying position for Magma with respect to the Aussie KRF market, Aussie US KRF market is long. Yes, everyone is convinced. Okay. Now we have do we have it? So we come to the next one, the dollar loan. All right. So what does it say in the case? Obviously, this is a dollar loan. So the first question we can ask ourselves. Remember, you're looking at market risks. So what did we say, that when you go in as any sort of if we go in here and we try to load our Where is taxonomy and perspective? Let's open this. So if you are if you are working as a risk manager anyway, either as a in a hedging situation or in a speculative situation, if you are deputed as a risk manager, your first job is to look at the entire active risk book or the passive risk book and identify all the risks. So you identify credit risk, market risk, okay, and then as we said in the notes when we discussed the taxonomy of risks, we have also clarified that especially when you look at market risk, which is usually the biggest component of the risk generally, especially on a trading book. So what you'll have to do when you're doing market risk, when you have subcategories of market risk, you'll have to again look at market risk according to this framework, which means you'll have to go, so if suppose you're the chief risk manager for a big bank like JP Morgan, right, you'll have to look at risk by asset class, you'll have to look at risk by instrument as well. So if you're looking at currencies, you'll have to go by each market, which means you'll have to go through Aussie, you'll have to go through Euro, cable, dollar, yen, every currency that these guys are trading. If you're analyzing the active risk book, the speculative book, okay, then in that case you have to go through every currency. So first you go into asset class, start with one asset class, okay, take one instrument, go through all the markets. So spot currencies, okay guys, tell us what exposures do you have in spot currencies. You look at all the exposures, you look at all the books, you look at the dollar yen trading book, the yen Aussie trading book, the euro, the GBP, and all the currency pairs that they are trading, everything that they are trading, okay, could be euro against Czech koruna and all these kinds of things, okay, all kinds of, so are you following the process? Are you following what you have to do as a risk manager? But everywhere you're asking the same question. You identify the KRFs, and you figure out what the underlying positions are, and then of course in this case the hedging will be done also by the traders. I mean, whatever risk management that is done, they are done by the traders. Your job is really to take care that the risk limits are not busted. But this is how you would look at risk. At least you would look at you'd go up to the point of identifying the key risk factors. So you would look at currency, start with one asset class, take one instrument, and then go into the spot currency market and look at all the key risk factors. So in spot currencies, your key risk factors will be dollar yen, Aussie, euros, cable, maybe dollar Canada, Kiwi, then dollar Swiss, okay, euro Czech, euro sterling, all these different books. Each of these will be a key risk factor. Are you following? This is how the scheme will work. And then you will have to proceed from here, go to the currency futures book, same exercise. Go to the currency forwards book, same exercise. Here, go instrument by instrument. Then once you finish this, then you go here, and here under options you'll have to look at the eyeballs as well. Now you're not just looking at in spot, you're looking only at the underlying asset as the KRF. When you go into the options book, your eyeball becomes an additional KRF, because the value of the positions will be affected mainly by two movements: the underlying asset price movement and the eyeball movement. So when you're looking at an option book, your eyeball becomes an additional KRF. Yes? Are you following? You already studied that, right? Because here we are talking about spot. Actually, these are forward Aussie exposures, but we are treating them as spot, and then we'll figure out how later on you can actually roll spot exposures forward. But these are actually, because these are loans to be paid 5 years later, so these are actually technically forward exposures, but we can treat it as spot exposures, and then we'll keep rolling the exposure forward, the hedge forward. That we'll figure out later how we do it with FX swaps. But this is the idea. Are you following the scheme? So this is also something that you should be aware of, that when you're looking at the management of, okay, you're not supposed to go out, so I'll have to cut marks. But I told you guys, no, I have to implement this rule. So you can go out, but I'll have to cut marks. Because, I don't like to do this, but because you guys have abused the process. So, yeah. So I'll have to implement the rule, otherwise there's no point. No, otherwise again everybody will start going out. So, okay. Because I've given you this rule. Now you have to finish all your work, water filling, whatever it is, that everything has to be done before the class begins. So during the class, nobody gets to go out. All right. So everyone has the feel of now. Everyone understands now how you look at market risk. Okay. Further, when you look at market risk, this is the exercise that you do, whether you're looking at a hedger's book or a speculator's book. If you're a risk manager, you go through asset class by each asset class, then by instrument, then move on to the next asset class. Once you finish currencies, then you go on to the commodities, and then you do the same exercise. Yes? Everybody's following what is being discussed? Yeah? If you're a risk manager, you will go through currencies this way, and then you'll go through commodities this way. Yes? Okay. And then equities, then debt, everything. The whole process goes on, okay, till the end. Hopefully this 100 is fine. Okay. So we come back to our, then we seem to have a problem, so obviously we can't. So on the dollar loan, let's ask this first question. So when you're talking about market risk, you look at all the different types of assets, right? So the first question you'll ask is there any currency risk on this loan? Yes or no? On the dollar loan, there's no currency risk because liability currency is equal to the asset currency. It's the same as the asset currency. So there is no currency risk. There's no currency mismatch. But can we say that this loan is risk-free?
No.
Let's look at the case. What does it say? The loan is not risk-free. Why? Yeah, the loan is risk-free because it does not have currency risk. Now you understand the importance of looking at different asset classes. Okay, so it does not have currency risk, but it has interest rate risk. Because interest rate risk, and as we have defined your floating rate, where the floating rate, the period for which the interest rate is periodically reset is smaller than the total tenor of the loan. Yes, that's how you mechanically define a floating rate loan to a computer, right? That is a hard, clear-cut definition. We can actually we can add something else here, which is that, no, this is we have defined a floating rate loan. The loan tenor exceeds the period for which interest rate is set and reset, okay, repeatedly, okay. So another thing that we can say is usually loan tenor is going to be an integer multiple. You understand what that means? Usually loan tenor is an integer multiple. You understand what that means? Integer multiple of interest rate reset this is just rounding out the definition. This is just rounding out the definition. This is all being written in your notes. Okay, multiple of interest rate reset, integer multiple of interest rate reset frequency. Let's call it. Okay. So again, very you can see how the definition is very precise. A computer will understand this. So which means essentially what this means is this part of the statement. I'll just explain it in case anybody is confused by it. All that this means is that if the loan tenor is 5 years, the interest rate reset frequency is going to be 3 months or 6 months or 1 year. Okay, so that means 5 divided by 0.25 is an integer, because 0.2 for 3 months is like 0.25 years, right? 6 months is 0.5 years. So 5 divided by 0.5 is an integer. Okay, that's what it means. So usually that's what you end up seeing, that you have a loan tenor. But this statement is only true at the time that the loan is disbursed. It is not necessarily true at the time that you come in to manage the risk on the loan. Are you able to follow the difference between the two? This statement is only true loan is disbursed, and also on at which other points will this statement be true? This statement, this concept, disbursed means first the loan is sanctioned, that Mehak is allowed to borrow $100 million. Then next the loan is disbursed means we credit your account with $100 million. That's the disbursement of the loan. Okay, that's when the interest starts counting. The interest clock starts running. Okay, and which other time, this is also an important concept in bond pricing and swap pricing. Are you guys following what is being discussed here?
Yes.
I try to give a tight definition of a floating rate loan. The definition is that the loan tenor exceeds the interest rate reset frequency. So loan tenor, say 5 years, interest rate reset frequency is 3 months. That's one. And the second, we are adding to that definition a little bit, that we are saying that usually the loan tenor is an integer multiple of the interest rate reset frequency. So I've given you those examples. Everyone understand the statement? Integer multiple? Okay. Now this statement is only true at the time that the loan is disbursed and at certain other points of time. Is my question clear now? Yes? What is the answer to my question? At which other points of time is the statement going to be true? Is the question clear? I have to make sure the question is clear, otherwise. What? This has an important implication for bond pricing, because we will have swap pricing on certain dates. The price will be equal to par because of when you're pricing floating rate notes and things like that. Okay, and on the yes, 5-year loan with a 3-month reset period. 5 divided by 0.25, 3 months is 0.25 years. 5 divided by 0.25 is an integer multiple, is an integer. Okay, so the loan tenor is an integer multiple of the interest rate reset frequency. But if I look at this loan after it has been on the books for 3 years, now there are exactly 2 years to go, and 4 more resets are there, are left. 4 more interest rate resets are left. Okay, and today I see the reset for the first of those 4 periods. Are you following what I'm saying? Yes? No? Yes? No? No. Okay, good. That's what I want. You need to give me a clear answer. So this is what we need. Okay. Alright, so let's say these are not equal rows. Why do I have such a big row here? Okay, let's go somewhere here and do this. Okay, so the loan tenor is, let's say we have a shorter loan. Okay, let's have a shorter loan tenor. We will have it 1, 2, 3, 4, 5, 6. Okay, so let's have a 3-year loan. Alright, so this is your loan tenor. Now your interest is being reset every year, every 3, let's say half yearly resets. Okay, so the statement is true at this point. When we are at this point, the statement is true because there are there are 6 resets. So 0.5. Anyway, say, the multiple is going to be 6 because you have 3 years and you have divided 3 divided by 0.5 is 6. So it's in the integer multiple is 6 at the beginning of the loan. But this statement is also true at any of these points. At this point here, the beginning of the loan, it's also true at this point. At the interest rate at the start, on the interest rate reset dates. Next interest rate reset date is here. Everyone can see my cursor. Next reset date is here. Next reset date is here. Next reset date is here. Yes. All right. So that's why I said this concept has an important application to pricing of bonds and swaps. Which we are probably not going to have time to get into in our courses, but you should understand this concept. So the statement that I made, that it's an integer multiple of the interest rate reset period, is also true on every interest rate reset date. Because at this point, what do I have? I have 1, 2, 3, 4, 5. Okay, so basically I have the integer multiple at this point is 5. At this point, the integer multiple is 4. Yes, because there are so the statement is true at all of these periods of time. Yes, that the integer multiple of the remaining periods, or the remaining interest rate periods that are there left in the, if you take the remaining interest rate periods left in the loan, this statement will be true on the interest rate reset dates. Is this clear? Okay. So I should have mentioned the remaining interest rate periods. Okay, this let's look at it this way. You don't know. Let's change the statement a little bit. Integer multiple of reset frequency, or Yeah, okay, so reset frequency is the same as the period, okay? So what am I saying? That the statement is true of the remaining interest rate reset. Well, we should change this word to periods. Tenor, and we are using tenor and period, okay? Are you following here? This is what I'm trying to say here, that the statement is true here because the number of remaining interest rate reset periods is 1, 2, 3, 4, 5, 6. So, and this is 3. So 3 divided by the 0.25, okay, the period is, you have an integer multiple, and this statement is also true at each of the interest rate reset periods. Is this clear? Okay, that's all we are trying to say here. Okay. Alright, so let's move on to the next point. Okay. Gurvit has already started getting restless. Okay. And a little bit early even for you. Okay. All right, guys. What is the thing? So what is the let's get this 3-month. Now let me try and get LIBOR. Where is LIBOR? Oh, we tried this the other day. It's not working. Okay, so we have we have to go back to our Fred chart. Okay, but so the risk. So what would we call the risk factor here? What is the KRF on the dollar loan? Yeah, interest rate. So we would say the risk factor here is a 3-month US dollar LIBOR, right? Let's go into this rates. So the KRF is 3 month. Where are the interest rates? What is the LIBOR rates? We can get we have LIBOR for, oh my god, this is not going to load if we have a interest rate, if we have a okay, so we would say that the KRF here is 3-month US dollar LIBOR. Alright, KRF is 3-month US dollar LIBOR. Okay, and what is the underlying position with respect to 3-month US dollar LIBOR? Okay, here we have to cut marks for Shreya and Shurbi talking.
Middle seats.
Where are we? Okay. So, is this clear? The KRF here is the interest rate. It's a 3-month US dollar LIBOR. Okay. Please note also that you can actually have for one particular exposure on the balance sheet, you can actually have 2 KRFs. We have not given this kind of situation here, but if now these are fixed rate loans, these Aussie loans are fixed rate loans, and the yen rain is also a fixed rate loan. This is given for sake of simplicity, but please understand that you could have for one balance sheet item you could actually have 2 risk factors, because you could have this yen loan on a floating rate basis based on 3-month yen LIBOR. In that case, you would have both currency risk, because the asset currency and the liability currency don't match. So you have currency risk as well. And you also, on top of that, because the same item on the balance sheet, you also have interest rate risk, because there is 3-month yen LIBOR, which means the yen interest liability itself is not clear. except at the start of the loan for 3 months or what, in this case it's 3-month yen LIBOR. Is this clear? That you have a loan of this tenor, okay, you have a loan of this kind of tenor, a long period of a loan, but your interest rate is clear, on interest liability is clear only for one reset free period at a time.
Yes, sir.
And then here it's not clear. Again, all these things what you're going to pay over here, this is not clear. So there are two sources of risk on this balance. If this item had been, and this is one of the problems we have discussed in the case, one of the questions that is asked, because the CEO wants to swap this into a floating rate. He wants to swap this into a floating rate loan. So therefore, that would create another, if he were to do that, that would create another KRF on account of the same balance sheet item. So understand that when you combine what you see on the dollar loan with what you have seen on the yen and the Aussie loans, here you had currency risk but no interest rate risk, because these are fixed rate loans. The total interest liability is known. For over the entire tenor of the loan, the total interest liability is clear because it's a fixed rate loan.
Yes, sir.
But here, in this case, you have this. So, but if it were these were floating rate loans, then there would have been two risk factors, two KRFs. On account of the same balance sheet item, there would be a dollar yen exchange rate risk, and there would have been a 3-month yen LIBOR exchange rate risk, interest rate risk, right? Two KRFs would have been there. In this case, we have only one KRF here, which is the 3-month US dollar LIBOR. Okay, now let's get through this question of what is the underlying position. Puneet, what is, now that we've identified the 3-month dollar LIBOR is the 3-month US dollar LIBOR is the KRF on account of this balance sheet item. Okay, the dollar loan, the floating rate dollar loan. Now the question has to be asked, what is Magma's underlying position with respect to 3-month dollar LIBOR? Yes, Puneet? Short. Okay, which means you're saying that if dollar LIBOR rises, they will lose money, and if dollar LIBOR falls, they will make money. Okay, does that make sense? Can everyone see the scale?
Yes, sir.
On the and now that the class is about to end, everybody is able to see the scale. Okay. Okay. So I'll make the scale even bigger because I don't think it's very clear. 1 minute. We still have time. There are 3 minutes. 3 minutes are left. Be quiet. Be quiet. 1 minute. Not 1 minute, but 3 minutes. Okay. So is Puneet correct?
Yes, sir.
If when yen LIBOR is rising, if their interest rate used to be say 1.13, sorry, not yen LIBOR but dollar LIBOR, and then if it rises rapidly, say to 5.37. then their total interest liability has suddenly gone up, right?
Yes, sir.
So for one period they were paying less, for here they were paying less in the first period, then next period they're paying more, and the next period they're again paying more, again they're paying more here, more and more and more, it keeps on rising.
Yes, sir.
So their total interest liability, first of all, they're not able to predict it at the outset. They don't know what the total will be, and every period the total interest liability for the 3 months seems to keep on increasing because 3-month dollar LIBOR is going up. Okay, so that's bad for the company. They're losing money. So Puneet is correct. So with respect to 3-month US dollar LIBOR, which is one of the KRFs, okay, the KRF for the dollar loan, the floating rate dollar loan, with respect to that KRF, their underlying position is short. Okay, and so what will you do if you want to? Now we have not got into that aspect of the discussion yet, but we have covered these so far. 1 minute. Okay, so we have covered all these, right? Now let's quickly start to think about what we are going to do. We still have about 1 minute or so, a little bit more than that. Just on the US, let's get the discussion started. If you are afraid, if let's say Puneet looks at the chart and he is very afraid that he is standing at this kind of period, please pay attention. If Puneet is the risk manager and he's very afraid that we are going to go into this kind of phase and dollar LIBOR is going to keep on rising, okay? So what is he going to do to the euro dollar futures? Remember, he has to hedge using euro dollar futures. We went through this discussion in the class before, remember? When I showed you how you use the fair value model, the price versus fair value comparison. You make a projection for your LIBOR setting, and then based on that you buy or sell the euro dollar futures, because the market, you compare the market price of the euro dollar futures to the fair value, your forecast based fair value, right? So what will Puneet do? Let me just quickly get you started on that. Initially, just few seconds left. What he will do is, suppose, where were we? Yeah. Suppose that the current level of dollar LIBOR is 1.885. Follow this discussion. Okay, we are connecting it to the hedge position. It's 1.8. Puneet forecasts that the next figure is going to be 2.15. 3-month dollar LIBOR will move from 1.885 to 2.15. Now the fair value of the futures contract, of the euro dollar futures contract, if Puneet's view is correct, should be actually 97.85. The current market price is 98.11. Okay, so the market is predicting a fix of 1.885 in the cash market for 3-month euro dollar deposits, but Puneet feels that the fixing will be actually 2.15. So he has a very bullish view on the euro dollar futures deposit rate. So the fair value according to Puneet's forecast is 97.85. Market price is 98.11. So Puneet will buy or sell the euro dollar futures. Market price is higher than fair value. Forecast based fair value. Are you following this? Forecast based fair value. Market price is higher than fair value. So he will sell. He will sell the euro dollar futures. Okay? Is this clear? Okay, you're done.